The defining characteristic of the second quarter has to be the Fed realization that inflation has remained higher and more persistent and is even accelerating. And we first saw a 50 basis point hike in May, but that was followed by a 74 basis point hike in June, which is the first time that the Fed has hiked by such a significant amount since 1994. But as a result of the Fed's recognition of the issue, the stock market has performed very, very poorly. And for the first half of the year, the return of the S&P 500 was actually the worst it has been since 1970. However, that is balanced by the fact that on the, I believe it's 6 previous stock market declines of at least 15% in the first half of the year since 1932, these were followed by an average 24% bounce in the second half. It hasn't happened every single time, but interestingly, what we have seen so far in July is a recovery in the stock market. And at this point, people are, I think, really just trying to determine whether or not the aggressive pace of Federal Reserve interest rate hikes will push the economy into recession. And so we're really balanced on a knife's edge, impossible to predict. But as we say, the best course of action is to simply remain engaged for the long term.
And as the world moves towards normalcy and resocialization, central banks have been signaling a countertrend by tightening and restricting financial conditions. Interest rates are much higher, and the prices of everyday items such as gasoline and commodities have increased. This, in part, is creating a lot of instability and volatility in the markets. Investors are having to sort of go through this process of finding at what point the tightening of financial conditions, whether it is by reduction of the balance sheet or raising of interest rates, is going to provide that opportunity where inflation will start kind of peaking and rolling over. Investors are trying to find and reestablish this point of what I call the center of gravity. There are a few regions of the world that are well positioned to benefit from these economic challenged environments, and that is the Middle Eastern countries known as the Gulf Cooperative Council, the GCC. This region is predominantly a region in which the Participation Fund invests in. The growth pattern and the anticipated positioning in the geopolitical world and climate for its safety and security is really positioning this particular region as an attractive and stable investment climate. And just recently, I spent a month in the region visiting issuers, participating in conferences, and speaking with the broker-dealers that I do business with. A large part of investing in emerging markets, it's culture, it's context, and that really is an important ingredient in being able to make discerning insight used to help drive the investment process that ultimately serves our clients.
Performance data quoted herein represents past performance and is no guarantee of future results. Investment return and principal value of an investment will fluctuate so that an investor's shares, when redeemed, may be worth more or less than their original cost. Current performance may be significantly higher or lower than data quoted herein. Performance current to the most recent month end can be obtained by visiting amanafunds.com or by calling toll-free 1-800-728-8762. Please consider an investment's objectives, risks, charges, and expenses carefully before investing. To obtain this and other important information, which you should carefully consider before investing, about the Amana funds in a free prospectus or summary prospectus, please visit amanafunds.com or call 1-800-728-8762.